In global finance, the United States dollar is inescapable. It sits on one side of 87% of all foreign exchange trades. It prices the oil that powers ships, the grain that feeds nations, and the debt that funds governments. Because the entire world needs dollars to trade, the United States enjoys a unique advantage. Economists call it the exorbitant privilege. Strong global demand allows the U.S. government to borrow massive amounts of money at lower interest rates, financing large domestic deficits with minimal immediate consequence. But economic empires are mortal. Look back to the 16th century, and the Spanish silver dollar served as the first truly global reserve currency, driven by the massive output of Spanish-American mines. By the 17th century, that dominance shifted to the Dutch guilder. The Bank of Amsterdam created a stable monetary unit, using practices that look remarkably similar to modern central banking. Then came the British pound, which commanded global reserves through the 19th and early 20th centuries. That lasted right up until the United Kingdom nearly bankrupted itself fighting 2 world wars, draining its wealth and leaving a vacuum at the top of the global order. This is a chart showing the US dollar's share of global central bank foreign exchange reserves. Since the early 2000s, that share has steadily declined. Today, it has slid below 60%, hitting a 2-decade low as central banks slowly diversify into other currencies. The structural demand for the dollar is eroding. If the world decides it no longer wants to hold its wealth in American currency, the mechanisms that keep the U.S. economy afloat begin to fracture. The dollar's current reign was formalized in 1944. At the Bretton Woods Conference, Allied nations agreed to peg their currencies to the dollar, while the dollar itself was tied to gold at $35 an ounce. That peg held until 1971. Facing a drain on U.S. gold reserves, President Richard Nixon severed the dollar's convertibility to gold. The world transitioned to a fully fiat system, backed entirely by confidence in the American government. To maintain that confidence, a new structure emerged. Global commodities, most notably oil, were priced almost exclusively in dollars. If a country wanted energy, it had to acquire American currency first. But providing global liquidity comes with a trap, the Triffin dilemma. To supply enough dollars for international trade, the United States must run a persistent current account deficit. The domestic economy absorbs foreign goods, while dollars flow out. Supplying the reserve currency also requires an exorbitant duty. In times of global stress, the U.S. acts as the ultimate insurance policy. Wealth flows out of America to stabilize foreign markets, draining the center to protect the periphery. We saw this clearly in March 2020. As the pandemic triggered widespread panic, investors worldwide dashed for cash. The Federal Reserve had to open massive swap lines and pump trillions into the system just to keep global markets from seizing up. The system balances massive privilege during peacetime with massive obligations during panics. It places immense pressure on American policymakers, whose domestic decisions now dictate the financial stability of the rest of the planet. The gravitational center of this system is the U.S. Federal Reserve. When the Fed adjusts interest rates to manage American employment or inflation, the shockwaves hit every market on Earth. This creates the global dollar cycle. When the Fed raises rates, American assets yield higher returns. Global capital eagerly flows back into the United States, driving up the value of the dollar relative to other currencies. For emerging market and developing economies, this cycle is devastating. Many of these nations hold massive amounts of debt denominated in U.S. dollars. As the dollar strengthens, the local cost to service that exact same debt skyrockets. This is a chart tracking global current account imbalances and financial flaws. Look at the bottom right panel representing low and lower middle-income countries. The sharp red spikes downward indicate severe financial outflows. When global dollar conditions tighten, capital abandons developing nations rapidly. The pain compounds locally. Because commodities are priced in dollars, a stronger greenback means a country's own currency buys less. Basic imports like energy, food, and industrial materials become crushingly expensive, sparking domestic inflation and slowing growth. This vulnerability pushes nations to seek an exit. Geopolitical rivals like China are actively establishing alternative channels. They are signing bilateral currency swap agreements and settling cross-border trades in yuan to insulate their economies from the Federal Reserve's lever. The push toward de-dollarization is a direct reaction to the mechanical volatility of the dollar cycle, as nations try to break free from a system that routinely exports American financial pressure to their shores. If those nations succeed, and the dollar slowly loses its grip on global trade, the math inside the United States changes. Investors currently accept lower interest rates on U.S. Treasury bonds simply because they are the safest, most liquid assets on Earth, a perk economists call the convenience yield. This Laffer curve models U.S. public debt capacity. The purple line shows maximum sustainable debt if the dollar retains its special status. If the U.S. loses that status, the blue line, sustainable debt plummets by nearly 30%, making borrowing significantly more expensive. The dollar will not vanish tomorrow. The euro remains constrained by fragmented fiscal policies, and China's yuan is limited by strict capital controls. There is no single, ready-to-go replacement for the U.S. Treasury market. The transition looks less like a sudden collapse and more like a slow fragmentation. The global financial system is gradually breaking apart into distinct regional networks, where trade is settled in local currencies and central banks hold diversified baskets of assets. As the dominance of the dollar erodes, the unique buffer protecting the American economy erodes with it. Without the world automatically absorbing its debt, the United States will have to finance its deficits by playing by the exact same rules as everybody else.